Okay, this problem just screams T account. Now I'm going to go through and do it one at a time. And they tell us, let's see, the company's ending inventory on December 31st and its fiscal year was determined to be $346,000. Okay, I'll take their word for that. Inventory. $346,000. Their unadjusted trial balance showed the following account balances. Purchases, $820,000. Well, I'm guessing it since they're giving us this information we're going to need it, so I'll write it down. $820,000. Accounts payable, $310,000. Accounts receivable, $325,000. $325,000. And sales revenue, $1 million. Okay, they give us those accounts. Pretty good bet there's going to be a problem with them. Okay, let's start at number one. Goods valued at $52,000 and held on consignment were included in the physical count of inventory, but not recorded as a purchase. In other words, we're holding these goods for somebody else. We counted them, but they're not ours. So we need to subtract that from the inventory. That's item number one. Purchases from Xavier Corporation were recorded at $82,000 instead of the correct amount of $28,000. The correct amount was included in the ending inventory. So we're pretty good with that one. We don't need to worry about that one. It was included, okay? Goods that cost $45,000 were shipped from a vendor, FOB destination. That means they're not ours till we sign for them. They arrived January 3rd. The purchase and related accounts payable were recorded in 2013. So we have a problem with that one. We need to take $45,000 out of the purchases because this is for 2014. So we have to credit the purchases by that $45,000. That's item 3. And what else do we have to do? We have to take that $45,000 out of accounts payable because we don't owe it right now. That's also item 3. Now let's see. One inventory item was incorrectly included in the inventory at 300 units instead of the correct amount of 2,000 units. So there's a 1,700 unit difference. So we need to take 1,700 units times how much? $40 per unit. And when we come up with that, that's a total of $68,000. So that goes into inventory. That's item number 4. Okay, and let's see. The balance sheet reported inventory of $552,000. So that's the beginning inventory. I don't know that I need that, but I'm going to write it down, okay? Because that's the beginning inventory. Remember, this inventory was the inventory that we counted at year end. This was the beginning inventory. Okay, and discovered that a mathematical error caused that to be understated by 82,000. And the amount was considered to be material, which means they're going to correct it, so we might as well take care of that. So our actual beginning inventory was 664,000. I'm sorry, 634,000. I had funny. Yeah, 634,000. I don't know if we need that, but it's there. Let's handle it. Goods shipped to a customer FOB destination, so they're ours until they sign for them, were received by the customer in January. So the sales price was 60. The merchandise cost 32. And we recorded the accounts receivable. Okay, so we have to get rid of, well, first of all, we have to put that 32 back in the inventory. So let's just do that first. Because that sale, no matter what we say, did not happen until next year. And the accounts receivable and the revenue were both credited or recorded for 60,000. So we have to reduce the revenue by 60,000, and we have to reduce accounts receivable by 60,000. That's item number 6. And goods shipped from a vendor FOB shipping point on December 27th. Okay, so FOB shipping point, that means they're ours the minute they leave the dock. Were received on January 3rd. The merchandise cost 38,000. We need to put that in. So we have another 38,000 to come into purchases. And let me take a look at this. This piece up here, we have to handle the difference. I skipped over that completely. So we have to increase the purchases by 82 minus 28. Was that 54? Right? 54, we have to put that in there. Yeah, so we have to remove another 54 from that. Because it was recorded at 82, but it was really 28. So we have to subtract that additional 54 from the purchases. Okay, so let's see, did we get everything? 52,000, we got that one. We got that one. 45, we got that one. We got those 1,700 units. We corrected the inventory. Okay. Let's just go through and balance the T accounts. Revenue goes to 940,000. Accounts receivable goes to 265,000. The inventory account, we got to add this final 38. We didn't do that. Number 7, we have to get that in there. We have to add that to the inventory. So when we add the inventory up, it comes to 432,000. The purchases, when we do that, it comes to 759,000. And our accounts payable is 310. And I think I missed some stuff here. Okay, yeah, that 54,000. I think we probably didn't pay that, so let's debit that from item 2. Okay, happens to be right across from it. And what else did I forget here for accounts payable? Oh, this one at the bottom. This merchandise cost us $38,000, and it's FOB shipping point, so that's ours, so we owe for that. So when you total that up, our accounts payable is $249,000. The trick with these is to get each piece, set up your T accounts, and just label them so that you know where each piece came from. It just makes your life easier. So we've done that piece. Now let's go through and fill in. I mean, now that we've essentially finished the problem, let's go fill in the blanks. So our ending inventory is $432,000. Our corrected purchases was $759,000. Our accounts payable $249,000. Our accounts receivable is $265,000. And our sales revenue, $940,000. Sneaky bastards. I knew they were going to get us for that beginning inventory. Okay, they want us to do the cost of goods sold computation. Okay, we can do that. Remember, we figured out the beginning inventory? So, beginning inventory, $634,000. Plus purchases, and we figured out there's purchases of $759,000 minus our corrected inventory of $432,000. Gives us our cost of goods sold $961,000. Okay, it says, what was the effect of the error in ending inventory on 2012 before tax income? Well, there's a whole bunch of ways we can do this. We can go back and we can figure it out and all of that, but I'm lazy, I'm old. Here's the deal. They tell us that the inventory was understated. If inventory is understated, income is understated by that amount. So it was understated by $82,000. Income and inventory travel in the same direction, always. So that was a pretty good overall problem. With those problems, you have to make sure you remember to do T accounts, get each and every item and label, label, label.